Parents already have enough to worry about. Saving for your child's future doesn't have to be overwhelming. In fact, it can be simple, maybe even a little fun. And I'm going to show you how to do that in today's episode. Hello, my fellow wealth builders. Welcome back to the Money Journey with Mila, the podcast for millennial women in their 30s who want to become wealthy on their own terms and in their own time. I'm your host, Mila. I'm your fellow 30-something-year-old woman who is on a mission to become very wealthy. I'm bringing you along on my journey every week where I share tips and tricks on how to start building wealth in easy ways. If this sounds like something that you're interested in, be sure to subscribe to the channel if you're watching on YouTube, or hit the follow button if you're watching or listening on all other podcast platforms. I hope you're all doing well. So during last week's episode, we talked about how to financially prepare and build wealth before your child is born. I got a lot of great responses from viewers, and they loved how much I covered, and they learned so much, which got me so excited to continue the series. So on today's installment of Wealth Building for the Next Generation, we're talking about how to create wealthy kids while they're young. So we're going to cover a few things, but first we're going to start off with how to invest for your child's future. Then we're going to talk about how to save for your kid while they're young. And we'll wrap up with how to start building credit before they turn 18. I'm so excited. These are great topics. And as I said last week, we wealthy women deserve to build wealth, not only for ourselves, but also for our children. So let's get into it. While researching this topic, one thing that stood out to me is that millennial parents are aggressively prioritizing savings for their children, particularly around education, with about 73% of parents opening up education savings plans. 36% of parents have over $5,000 saved. That's amazing and so great. And in my opinion, I think that parents are prioritizing saving for college because so many millennials were burdened with student loan debt. Many of us were or are still in 5 to 6 figures of student loan debt and are struggling to pay it back. And that experience can be overwhelming and traumatizing. It definitely was for me. It was not a walk in the park. So we don't want our children to go through the same struggle. Personally, I vividly remember telling myself as I was getting over the shock of being in 5 figures of student loan debt that I was going to prioritize saving for college for my future hypothetical child because I didn't want them to go through the same thing I went through. Last week, we talked about how you can open up a 529 plan before they're born. But the key to keep that account growing is to make consistent contributions early and often. As I mentioned last week, the cost of college is increasing every year due to inflation. According to an article from savingforcollege.com, the cost of college for an in-state 4-year university degree will be around $200,000 in 18 years. And this includes covering tuition, room, board, a meal plan, everything. And I used a college cost calculator to identify how much you need to save per month in order to get to this $200K number. And I'm going to leave it in the show notes. But the example that I'm going off of is you are going to be using a 529 plan that is an investment account, not a prepaid tuition plan. And you are going to be contributing $500 every month for 18 years. Since it's an investment account, you're assuming that you're going to get an average rate of return of 7%. So within 18 years, your account will have grown to more than enough to cover for the in-state tuition. And it's a sigh of relief when you start investing early. You won't have to worry about it in the future, but honestly, it's kind of gross how much college is going to cost in the future. I just wish it would be cheaper, but I can only imagine how much out-of-state tuition is going to cost. But the key here is to continuously contribute to the account, and it will grow over time. Now I want to move into investing for your child. And by investing for your child, you can just build a nice nest egg for things like wedding costs or cars or a down payment for their first house. And this is just a great way to save outside of education. And one way to do this is through a custodial brokerage account, also known as a UGMA or a UTMA. And with this account, there are no income or contribution limits, no early withdrawal penalties or restrictions on how the funds are used for the child. It allows you to invest in things like stocks, bonds, and mutual funds. So it's like a regular brokerage account. However, there are some cons that come with this account. First up is once money is in the account, it cannot be withdrawn for any reason other than the child's benefit. So it's an irrevocable gift. Also, parents, once the child is at an age of majority, which is around 18 or 21, the child gains total control over these funds. So they can spend the money as they see fit. Another thing to look out for is as this account is a student-owned asset and it is not in the parent's name, this can actually hurt the child's financial aid eligibility more than parental assets. And lastly, this account has tax implication. Income over a certain threshold, like say 2,700, which was for last year, is taxed at the parent's marginal rate. So this can impact taxes. I can go into this in a future episode. So since there are some cons that come with this account, what are some ways that parents are investing for their child's future? I looked on Reddit and saw that some parents are actually opening up brokerage accounts under their name, which give them full control of the account and they can do with the account as they see fit. So maybe that's something that you want to look into. Before we move out of investing for your child's future, I want to talk about how you can maximize your gifting strategy when it comes to these accounts. Instead of asking for presents, say as your child is growing up, you can actually ask your loved ones to contribute to the 529 plan or the custodial brokerage account of your child. And many 529 plans or brokerage accounts offer links to contribute to the account. They're called gifting links. And the 529 plan that I actually have has a gifting link. So in the future, say when I have a baby shower, I can share this link with my loved ones so they can contribute to the 529 plan if I don't want them to give presents. But any gift is great. Another alternative is say if your child receives cash as they're growing up during birthdays and holidays, I know I did, the parents can deposit that money into their child's 529 plan or brokerage account. So these are just some ways to strategize how you can use monetary gifts to grow your child's wealth. Now I want to move on to savings and how you can start saving for your child at an early age. Many of us had a savings account growing up. And with a savings account, this can help your child understand the value of a dollar, learn about interest rates and APRs, and just develop good money habits. Many banks and financial institutions have launched several savings accounts designed specifically for kids. So I looked up what is the best savings accounts for kids? And CNBC shared an article recently of the top savings accounts, and I can't believe who came out on top. CNBC voted Capital One Kids Savings Accounts the #1 savings account for kids. And this makes me so happy because a personal tidbit about me is that Capital One is my bank of choice. And it has been my bank of choice forever, really. I was with this bank when they were a trust company bank. If you know, you know. But back to the Capital One Kids Savings Account, because I found out some great things about this account. This account has no age requirement, so parents can open up an account before their kid says their first words. However, grandparents and adults must wait until the child turns 12. One good thing about this is that children can check the balance of their account via the Capital One mobile app. But the adult on the account must sign in to transfer or withdraw funds. And this just makes me think back to when I had a savings account as a kid. I would bring any money that I got in allowances or gifts or spare change that I found. I would bring that into the bank. And it was so cute because back in the 90s, they had a little savings booklet that the bank teller would stamp or update every time you contributed money to the account. And now looking back, this was just a great way for me to understand the value of the dollar and understand savings and putting money away for the future. Other benefits that come with the Capital One Kids Savings Account is it has a competitive APY, which is around 2.5%. It also has no fees and no account minimums like a regular Capital One account. Another alternative that you can think about using if, say, you don't want to have a kid savings account is you can open up a high yield savings account for your child and just start contributing to that because high yield savings account have a 10 to 12% higher interest rate than a regular savings account. And in the show notes, I'll leave a link to some of my favorite high yield savings accounts. Before I move on, I want to know, did you have a savings account growing up? Who was it with? And what did you learn about money by having a savings account? Now, I want to wrap up with establishing credit for your child before they turn 18. Now, building credit for your child will help them establish a positive credit history and empower them to borrow money for bigger purchases later in life as they'll have a good credit score. And you can start building credit for your child by adding them as an authorized user onto one or more credit cards. Now, there is no legal minimum age for adding a child as an authorized user. However, you should check with your credit card issuer's policy. Chase does not report the authorized user's credit history of minors to the credit reporting agencies. So that's something you want to think about. Personally, I have seen the positives and negatives of opening up credit for your child while they're young. One of my friends shared that her mom actually established a good credit score for her while she was a child because she added her as an authorized user on her accounts. So when my friend was a kid, she didn't really understand this, but when she graduated college and went to open up her first credit card, she saw that she had an amazing credit score. So she was able to get approved for a pretty great credit card that came with great rewards and great benefits. It's just a really great positive of how establishing credit for your child can benefit them. However, on the flip side, I did also have a friend who told me that their mom had established great credit for them growing up. But when my friend had opened up their first credit card, they actually tanked their credit score because they didn't have a good grasp on managing credit. So they ended up like making purchases that they couldn't pay back, and they got charged interest and late fees. So when thinking about establishing credit for your child, you also want to make sure that you're teaching them good credit card maintenance. I have a podcast episode all about how to manage credit cards. I'm going to leave a link in the show notes to this episode. So let me know, when did you first start building credit? For me, when I started paying back my student loans frequently and on time, my credit score went up. So by the time I was student loan debt free, my credit score was about 700, which was pretty good. But by having the experience of paying back my student loans, I not only learned discipline, but I also learned about credit reports and credit scores and how making sure that you're paying back your debt can positively impact your score. And in the next episode, we're going to talk about how to introduce money concepts to your child while they're young. Things like investing, spending, and establishing credit. So in turn, you can provide them with a good financial education and foundation for their future. So that's all I have for you today. And I hope you enjoyed today's installment of Wealth Building for the Next Generation on the Money Journey with Mila podcast. I hope you enjoyed this episode, and be sure to like this video or share it with a friend who you think might find it helpful. If you have a question or a suggestion for me, drop it in the comments or email me at hello@themoneyjourneywithmila.com. Be sure to follow me on socials at Money Journey with Mila. I hope you have an amazing rest of the week, and I look forward to chatting with you next time. Bye for now.